My next guest says he's still finding attractive names with a higher payout. Joining me now is Dan Genter. He's the CEO and Chief Investment Officer of RNC Genter Capital Management. Dan, welcome to you. So, let's start with just kind of very basically where you see dividend yield and how important is this still for investors?
Well, it's hugely important, and it's become increasingly important, Kelly, as obviously the interest rates have gone down. I mean, you're looking at a bellwether 10-year Treasury at 1.5%. A big part of this population, all the baby boomers, are either preparing for retirement or they're retired, and they need income. They need cash flow, and that's been declining. And whereas dividend, like early in my career, dividends were kind of an also-ran. Oh, it pays a 2.5% dividend. That's nice. But now it's a major source of income, and company managements are realizing that. So they're seeing they can add shareholder value not only through stock buybacks, but they can do it by increasing dividends. And people are hunting for that. And they'll, in many cases, depending on how high the dividend is, they'll buy the stock just for that. So yes. I think it's a trend that's going to continue.
So here's a follow-up question. I have a lot of dividend questions these days, given everything that's been going on here. Do you have people who would literally buy, let's say, a 5-6% dividend yielding stock, even if they think the price is going down?
Well, they're not going to buy it if they think the price is going down, but they will definitely buy it if they think the price is going to be stable. Because sure. The reality is, if you look at a lot of these large cap companies that have been paying dividends for a quarter of a century consistently, the prices tend to be fairly stable or at least inch up slowly. So if you look at an investor and say, well, look, I can get 6% in dividend, it still has preferential tax treatment, and a maximum of 20%, most people 15%. And look, 3 years down the road, if the stock has done nothing, if it's just at the same price, oh, hey, I got my 6%. It's pretty good. So all you have to do is say, okay, I feel over a 3 to 5 year cycle, it's not going to go down. And that's a safe bet with a lot of companies.
Let me ask you one more question. I really appreciate all of this. It's about a stock you're not necessarily coming to talk about today, which is AT&T. There's a stock with a very high dividend yield. Let's see where it is as of today. 8.4%, basically. Right. I'm sure there are people salivating for that kind of yield, and yet the shares are at about an 11-year low, depending on kind of where they wiggle each day. Would that be a good candidate for a dividend portfolio or not?
Well, I think what you have to realize is, as I mentioned earlier, you don't want to buy companies that you think, number one, the share price may be going down, or frankly, that the reason the dividend yield is so high is that the price has gone down. So the dividend just stayed the same. The price went down, so the current yield is now elevated. But that's an environment to where you may have a very high probability they're going to cut the dividend, and then that can be a death bell to a stock that's like that if it's not priced in. So you don't want to just chase the dividend yield. You have to look at the level of the yield, the sustainability of the yield, and make sure those companies are viable and earnings are going up and cash flows there to support the payout ratio.
Yeah, and again, I'll leave the fact that it's not one of your choices, so people can read into that what they will at this point.
Right.
So let's talk about who you would recommend: CVS, Phillips 66, Dow Chemical. Talk about why those three in particular jump out to you.
Well, I think CVS is an interesting play just because it's a company that's going through a transition that I think is going to be successful. And the bottom line to that is they are no longer just a pharmacy. I mean, they are going to be an integrated healthcare provider, mainly providing, non-critical elements where you don't have to go to the emergency room, but you're feeling bad, and they're doing that very successfully. The dividend is strong. It's about a market dividend, a little higher at 2.1. We think that that's stable. At a 12 PE on what we see as earnings, we just think it's a good overall return. There's others that are higher dividend plays like Phillips 66 and Dow. There too, we think we see significant value with very low PEs in the 7x range, but they're paying you 4.7% while you wait, and they're increasing dividends 8 to 9% a year. So you're not only getting 5% while you wait, taxed at no more than 20%. They're giving you a 8-9% raise every year. So very few things you can get high income, and then you're going to get a raise that's probably bigger than what most people were getting every year in their paycheck.
Well, and my final question kind of goes back to Phillips 66 and some of the names like that. There seems to be kind of this ideological battle that takes place in the boardroom when you have a high proportion of your shareholder base that's there for the dividend, because companies often have to face a choice with that capital. Do they reinvest it for the future, or do they pay it out? And I know that for many, they can do a little bit of both, obviously. But, at a time of energy transition, we're looking at companies like Exxon and Chevron and wondering, do they just pay the cash back out to shareholders, or do they try to invest it for the future? And I wonder if the dividend base represents to some extent a challenge that companies have to overcome, because they say, if we change and have to make these big investments, we're going to completely lose a portion of the share base that's here just for the payout.
Yeah, look, it's an ongoing battle, and boards have been making that decision every quarter for 150 years in this country. So it's nothing that's going to be new, and clearly it's a liability. I mean, it's a big number. It's a big payout when you look at free cash flow, and then when you're looking at it as even a percentage of earnings and the payout ratio. So you've got to be cautious to make sure that you're going to be able to, to keep paying that, and they're going to have the cash flow to do it. I mean, the companies like we're mentioning, they've been doing this for a long time. They don't do it willy-nilly. They have very sophisticated budgeting processes. They also know that a cut in dividend is something that's very devastating to the stock. So they do it very cautiously in putting that forth to make sure they can still meet their CapEx plans and still meet that cash flow. But right now, I don't want to say it's easy, but it's an easier time. I mean, earnings are up 60% this year. Free cash flows are soaring. And you're in a situation to where cash reserves on average for public companies is 28%. It's at historical highs.
Wow.
So they're making the money. They've had the cash flow. They have the cash reserve as a backup if they need it. So they see, look, we can pay this out, and people are going to gravitate to our shares. And it's a tremendous way to create shareholder value. There's a big demand for it in the marketplace by investors, and companies are going to hear that bell.
Fascinating. Dan, thanks for letting us probe into this a little bit. Really good to have you on today.
My pleasure.
Dan Genter with RNC Genter Capital.